Welcome to Accounting Expo. Today we shall be looking at the topic trading profit and loss account. Trading profit and loss account is a nominal account that contains two different accounts, trading account and profit and loss account. The trading account is used to determine the gross profit, that is the profit realized from the act of buying and selling. Trading account is prepared by a trader because it is the profit realized from the goods bought and sold that is determined in the trading account. So it is used to determine either the gross profit or the gross loss. The profit is said to be gross profit if the total net sales is more than the cost price of the goods sold. But it will be gross loss if the total cost of goods sold is more than the net sales. Now, trading profit and loss account is referred to a nominal account because it contains expenses on the debit side and revenue on the credit side. Knowing fully well, in line with our classification of accounts, that nominal account is the account of expenses and revenue. So it's worthy of note that the trading profit and loss account, being a nominal account, is the account that contains expenses and revenue. Now, let's go to the terminologies of trading accounts. Let's look at trading account first. Trading account, we have sales. Sales is the total cash sales and credit sales for the period of under consideration, and it is written on the credit side of the trading account because it is revenue. Remember that revenue is written on the credit side. Then from the sales, we less return inwards. When we sell goods to customers, the goods go out. But when customers are returning the goods to the organization that they are no longer buying, it comes back inside. So the return inwards is no longer part of the sales. Now, on the debit side of the trading account, we have opening stock. Opening stock is the stock of unsold goods in the trader's shop at the beginning of an accounting year. That is, the goods that were not sold in the previous year will be the opening stock. It's also called inventory. Then, if the goods are not enough, definitely the opening stock is likely not to be enough to make sufficient profit, and as a result of that, additional goods will be bought, so followed by purchases. Purchases is the total credit and cash purchases. So in the course of purchasing the goods, there are some expenses incurred, or there are some expenses incurred. We have wages. Whenever we are making reference to wages has a direct impact on the purchases. So wages will be added to purchases. Then the cost of transporting the goods from the place of purchase to the trader's shop, which is known as carriage inwards, will be added to the purchases. Then return outwards. Return outwards are those goods that have been bought by the organization, later returned back to the person it was bought from, maybe due to defect. So when such goods are returned to the trader, the person that the goods were bought from, he can no longer be said to be part of purchases, so it will be deducted from the purchases. But peradventure, the owner of the business withdraws money, removes goods from the business for personal usage. sold goods will not be available for sale. So drawings, goods withdrawn by the owner for personal usage will be deducted from the purchases, or the purchases to get the net purchases. So the next thing is to add the opening stock to purchases to get the cost of goods available for sale. Now the mere fact that the goods were available for sale does not mean that the organization will sell everything. So the goods, the unsold goods in the trader's shop at the end of the accounting year is known as closing stock, which will be deducted from the cost of goods available for sale in order to get the actual cost of goods sold for that year. Now the next thing is to compare the cost of goods sold, the actual cost of goods sold for that year, to subtract it from the net sales or turnover in order to get either the gross profit or the gross loss. Thank you and God bless.